Welcome everybody to our Future Proof Your Retirement free monthly webinar, where we will be going over some critical details on midlife planning for late life success. While you will meet all of us during the presentation, I did just want to make a quick introduction to the Future Proof team. So we consist of Alisha Mack, who's a senior living advisor with Oasis Senior Advisors, Joy McMurchy, a certified financial educator, and my name is Jackie Walter. I'm a health and Medicare insurance broker with Translating Insurance. And today we have two guest speakers, so it's pretty exciting. We have Jessica Scolastico, who's a mortgage loan officer with CMG Home Loans, and Brian Hoge, who is a senior real estate specialist with Oregon First and a home contractor as well. So our purpose when we created this resource group is to focus on educating people so they're prepared for a successful and crisis-proof retirement and late life. While you just met the founders, every month we do have guest speakers who are adding value to our free webinar, including speakers on estate planning, forever home planning, supplemental insurances, and tax planning as well. So our vision is to bring up those questions that you wouldn't think to ask so we can help you prepare before it's too late. It's always better to have a plan before you are in crisis mode. So our first presenter today is our beautiful Joy McMurchy.
Thanks so much, Jackie. This week or this month, I'm going to be a little bit more specific of a topic than I usually speak on. We're going to be talking about moving your home from a liability to asset and sort of the life cycle of your home in your financial plan. First off, though, before we get started, these are the 7 money milestones that my team uses to walk people through the process of creating a plan to reach financial security and independence. And all of them are essential when it comes to reaching that independence that most people are looking for. It doesn't look initially like your house really fits into these 7 steps, but in reality, your house actually touches all of them. And so that's sort of the path I'm going to take you on today. First, a quick definition. What is an asset and a liability? Most people, if you ask them if their house or their car is an asset or a liability, they will probably say asset because it's a big purchase. It's something that they feel increases their net worth. But looking at these definitions, is that really true? Do our cars help put money in our pocket? Are our houses helping put money in our pocket? Almost never. So the majority of the time, they are liabilities. Unless you are working for Uber or on Airbnb, your house and your car are definitely liabilities. But we can talk about moving your house into that asset category. First off, with financial education, there are so many misconceptions about houses and how you buy a house and how you plan for buying a house. I'm sure most of us have heard you need 20% down is the only way to buy a house. Don't even start looking for a house until you have that saved. Do not do that. That is what my husband and I did. We nearly got priced out of the market because we spent so much time saving up that $30,000 for our $150,000 house that by the time we went shopping for that house, it did not exist anymore. And houses were all about $250,000 at that point. What were we going to do? Instead, what I would recommend is talking to a financial advisor, mortgage professional, and realtor to make a plan for what it looks like for you to buy the house that you want. How much do you need to save up? What's the timeline? What's the market doing at the time? And making sure that if you are saving for that house, you are saving it in something that is keeping up with inflation, which we did not do. Proper protection has to do with your insurances. And this is one of the biggest reasons why you should make sure that you're including your financial advisor in the process of purchasing a home. I can't tell you how many times I've had this situation sitting down with a client. They've got a life insurance plan. They've had it for about 5 years, $250,000 of 20-year term. Seems like a lot of money, but they just bought a house. It's a $400,000 mortgage for 30 years. They've got $150,000 and 15-year gap when it comes to what happens if one of the spouses passes away before this house is paid off. Everyone I talk to, when I say, what do you want your life insurance to be able to do for you if something happens to you? And everyone says, I want my house paid off for my family. And if this is what we're looking at, then they needed to do a life insurance review to make sure that the amount of life insurance coverage they wanted matched the goals that they had. And this little dime method on the side actually talks about all 4 areas of what your life insurance could do for your family. Do you want to pay off debt? How much income do you need to replace? Do you have a mortgage that needs to be paid off? And is there any education needs for either your children or your spouse if you were to pass away? Emergency funds. So key when it comes to you are now your own landlord. So if something breaks, you're responsible for it. This was something I was very grateful for when we were working on buying our house, that our financial advisor said, don't use your down $30,000 for your down payment. Set aside $10,000 of it for an emergency fund in case anything breaks. 2 weeks later, we had a $5,000 sewer repair. I am so grateful that they did that advanced planning with us to make sure that we had that money available for that immediate need. Another misconception is 3 to 6 months of income in a savings account in the bank that's probably earning 0.01%, which is like a penny on $1,000. So instead, you're going to be looking at what are potential emergencies that you want to prepare for. Maybe 6 months of your income, which could be $50,000, is really not necessary for your specific situation. Also, having different types of savings and making sure that your money is growing and keeping up with inflation in all different categories. Your immediate savings is things that they break that day, you need to buy it that day. Your tire goes out, your refrigerator needs to be replaced. How long can we live without those things functioning? Midterm things, you've got a little bit of lead time on that. You probably have 3 to 5 business days to pull money out of that account because it's going to take a few days to get that repair taken care of. You know, a tree falls on part of your house or something and you need to have the roof repaired. It's not going to happen tomorrow. Long-term things could be things like adding an addition onto your house. These are things that you're not going to need the money for maybe 10 years, but you want to make sure that the money is there when you're ready to use it. So all of these things are important when thinking about different types of savings and not just having a huge chunk of change sitting in your bank doing nothing. Debt management. We have another myth. Pay off your house as fast as possible. Is that a wise idea, especially with some of the historically low mortgage interest rates that we've seen in the past few years? Not uncommon to see down in the 3% or even lower when it was at the absolute lowest, which was incredible for buyers. Instead, like when we're looking at that, do you want to spend money on paying off a debt with the lowest interest rate you will probably ever see in the financial industry? Or would you rather be growing your money and getting an interest rate of 4 to 12% on average? It can even go higher than that. In 2020, we saw some accounts do 20% or more. But why, sorry, I just lost the word here. What is the word I'm looking for? Hinder your ability to grow your wealth when you are focusing on a very low interest debt. Cash flow. This is when your house is actually making money for you. So here's an idea. You are needing a new house. Maybe you have more kids or the kids are all out of the house. You're ready to downsize a little bit. Maybe think twice about selling your old house. You can pull the equity out of your previous house, use that equity to buy the next house, and turn your previous house into a rental or vacation home. This is something that more and more people are using to build their financial portfolio to include different types of income. And if being a landlord directly is not necessarily for you, you can always use a property management company to take care of those day-to-day needs if you are not up for it. Building wealth. What happens when your money is parked in your house? This is one of the big challenges of living on a fixed income that a lot of seniors are dealing with. When you're talking about a fixed income, inflation is your biggest enemy. Inflation will double the cost of goods every 20 to 25 years on average. But with what we've seen over the last couple of years, it's actually a little bit shorter than that. So if you're going to be in retirement for 20, 30, maybe even 40 years, which is happening these days, you're going to go from maybe $5,000 a month being very generous income to all those same goods costing $10,000 a month. That double is really a serious thing that many, many people are dealing with. And it really means a limited ability also to meet emergencies. If you are just dealing with your monthly income and you don't have sort of a pot of money on the side to deal with a potential home repair or your car needing to be replaced, where are you going to get the money when those things happen? And then finally, long-term care and medical costs becoming increasingly expensive means that most people just do not have the money to meet their needs. So the solution for some people might mean taking that house that's they've paid off, that has had a ton of equity over the last several decades, and taking the money out of that asset and turning it into something that can then increase their income or be a pot of money that they can use to meet necessary additional expenses. Okay, protecting wealth. If you own property, a trust is highly recommended when it comes to making sure that your property passes on to your heirs how you want it to. The courts are not involved. You do not have to go through the probate process, and it's a very smooth process of transferring property, and then you have instant access to everything that is in the trust, as opposed to needing to wait for potentially 2 years to go through probate. So here we have our tour going through these 7 ways that the house can sort of figure into your plan. And when it comes to working with me and my team, we really want to focus on making top-level financial strategies available to ordinary people. And so we have a large team of specialists that help with all sorts of different things: estate planning, insurance, investments. And we'd love to sit down with you and talk about your home ownership goals or how to use your home to best meet the rest of your financial needs.
Thanks, Joy. And next up, we have Brian Hoge, our real estate broker. So Brian, I'm going to let you take it away.
Thank you very much. Excellent presentation, Joy. And I'm hoping that my presentation reinforces some of the excellent points that you've made. And what I'd like to focus on is speaking to the benefits of caring for your home and how a healthy home is a great investment for your future. Again, my name's Brian Hoge. I'm a real estate broker and a seniors real estate specialist. That's the National Association of Realtors certified designation. And my brokerage is Oregon First. That's where I hang my real estate broker's license. So I'd like to tell you briefly about a client. Her name was Sandra, and she owned her home for 20 plus years. She was widowed. So when I met her, she was in a bit of distress and there was anxiety, and that was largely due to the existing mortgage, existing debts from healthcare and services from her late husband required for him, and some other debts as well. And with all of the things and the turmoil of an extended period of time of illness for her husband, Sandra became overwhelmed by home upkeep and expenses, which is natural. I can relate to that. And when Sandra and I met, she was grieving the loss of her spouse. And over this period of time, the home did become unlivable because there wasn't a plan in place and a partner to discuss things with and prioritize repairs and maintenance issues with. The house became unlivable due to a major breakdown of systems like the furnace and some things that were aging faster than the dollars available to catch up, like the replacement of the roof in this case. So being a real estate broker, I was called in to talk about a marketing plan, and with a very slight amount of dollars, in Sandra's case, $1,000 in repairs, we were able to get the house on the market to where it would be likely to appeal to the most buyers and also qualify for the most mortgage options. And but generally, or often, we see people spending, my clients spend between $10,000 and $40,000 for getting the house ready to market. And it just depends on their priorities, their financial resources, and if we identify the return on investment will be there. This did turn out to be a unique financing situation. And my goal is always to advocate for the best price and terms and help my clients be free to start a new life. So I am duly qualified in the state of Oregon to meet my clients' needs. And the first way is as an Oregon real estate broker. And I'm specialized through the SRES designation for serving 50 plus aged clients. And through my partnering with the people you're meeting here today, I'm able to bring in relocation services, refinancing, selling of that home. My experience, my training, my personal beliefs help me have patience and understanding for the emotional aspects of transactions and transitioning people in this age bracket of like 50 to 90s. And I'm always looking to fit a plan that will suit clients' living needs with their overall life plan and helping them to fully enjoy their golden years. The dual qualification is through being an Oregon licensed contractor. I'm licensed as a general contractor, operating my business called Brian Hoge Painting, LLC. Over 40 years of home experience, specialized in older homes because they tend to have the most deferred maintenance. That's where we can offer the most benefit to our customers. Listening and communicating with customers is what it's all about. And we don't have a singular focus. If it's just painting or siding they need, we try to look at a holistic approach or a whole house approach to identify underlying issues. Our goal is to come up with solutions for extending home longevity. And I do have an extensive home services network of service providers. So speaking to the maintaining a healthy home, here's an outline of where dollars can be best or worst spent and have the best rate of return or return on investment. The best approach when you're a homeowner is good home maintenance habits and awareness. Certainly getting out in all seasons possible and looking at your home or having a professional look at your home. The attic and the crawl space are places where serious problems could develop, but we never look there. I've owned my current home for 3.5 years. I've never been in the crawl space. That's natural, but I think about it, it actually bothers me and it needs to be looked at. So maintaining the home with good habits and awareness is a proactive approach and makes you aware of any repairs, and generally if they are or the replacements needed, when you're on top of things, they're the least expensive. The minimum we should all be doing is quality repairs and replacement when needed, as in Sandra's case. Again, there was a lack of partnering, a lack of experience, and it made it difficult to decide to make these decisions, and things got bad quickly. Updates are good, and that's a best investment. The worst case scenario is not having good maintenance habits or awareness and allowing system deterioration, roofs getting dated, gutters leaking or full, exterior paint degrading, the furnace not working and the flooring are all issues and indicators where other problems might exist, and good easy places for us to get our eyes on and know that if the gutters are overflowing, they need to be cleaned, but also overflowing gutters lead to paint degrading and substrates degrading, like wood rot starting. Very common place for things to start with gutter or roof issues. Gutters are really inexpensive to replace or repair. It's usually much less expensive than people think, but it leads to so many other issues. You might call it the trickle down effect. As I said, gutter problems can lead to paint problems, can lead to wood rot problems or substrate problems, can lead to crawl space problems. So it's something to keep our eyes on. And when we have these problems nagging us, or the livability or the joy index of living in our homes decreases, then it affects the enjoyment. And that's obviously going to be the most expensive thing. So how can we help our loved ones? Encouraging good maintenance habits are something that I like to cultivate, and I would recommend helping folks budget for these things, either through good family conversations or a great service provider like Joy, using the tools that she has to offer. Could be great ways to help loved ones. Insist on decluttering. This will help with reducing safety hazards. Will also ease overall housekeeping. I love to encourage minimizing stored items that are not being used. I've felt so unburdened since emptying the garage of unneeded items and emptying my closets of unneeded items. It's just freed up my mind and freed up my space. And I see such good response and improvements in people's overall well-being when they declutter. And helping our loved ones check areas of homes where they maybe can't get to anymore, like a second floor or a loft space. So checking areas of homes that and the property, maybe there's a shed or a barn, a detached garage that are no longer frequented by our loved ones. The think about selling is always before crisis mode hits and before it's too late, before a home becomes dangerous and or before they're unable to care for themselves in the home. What are good ways for helping your home fund your next phase of life? Definitely keeping up on the maintenance. Best return on investment areas, if you're considering something, living room flooring, throughout the house, anywhere in the house, basement conversions, a great ROI, the roof, the garage, good old-fashioned curb appeal, decluttering and depersonalizing before marketing home is great. Neutralizing colors, neutralizing odors, all great things to help fund your next phase of life. Get the best ROI out of your home owning investment. How do you pay for some of these services? Options are cash, a home equity loan or line of credit, which we're going to hear about a little bit more. Zero interest credit card may be a great way to do it. A reverse mortgage could be a way to pay for home repairs, or find a way to stay in the home. And contractors will often agree to be paid from proceeds at the time of sale, or closing, as we call it in the industry. If you have any questions, I'd love to help you learn ways to get your money to work harder for you. I'm available through this contact information. And thank you very much for listening.
Thank you, Brian. That was great information, really helpful. And next up, we have Jessica.
Thank you, Jackie. And thank you, Brian and Joy. I think those have all been great points. And I agree. I think we're all going to dovetail together quite nicely about how to make these homes into assets and not liabilities. So my name is Jessica Scolastico. I'm with CMG Home Loans. I'm here to talk with you about a couple of different options so that you can keep that equity liquid later into life, or as you prepare to go into later into life. And we'll get started. So the three biggest options really that we're going to talk about today are reverse mortgages, home equity lines of credit, or HELOCs, as you'll hear them referred to. And then there are also options for things such as an all-in-one loan, which is really ways to both purchase a home or to refinance the home that you're currently into. And I think a great point to really talk about first is that Brian mentioned, is your home ready for you to go into retirement, or is there a different option, a way to downsize or right size the home so that all of these financial options work with the physical option as well too, and that your home overall is something that you're going to have less maintenance on, less worries about, and be able to increase that joy index. So just to kind of start off, reverse mortgages are something that it's a product that's eligible to clients that are 62 years or older. So it's something that a lot of clients, I feel like, have heard about in not a positive light. They have heard about, you get your home taken away or the bank takes it away. Those are the reverse mortgages of old. The FHFA, who is in charge of overseeing government-backed mortgages in the United States, actually took reverse mortgages off the plate for a very long time to make sure that ultimately they protected the clients that were in them and didn't hurt them. So the reverse mortgages of today are kind of backed also by mortgage insurance, but with a lot of stopgap so that we make sure that your equity is still protected. So for instance, the loan to value is based on the age of the occupants. As you get older, you can take more of your equity out, but it's really to protect you from going upside down in your home. If you do go upside down in your home, once you exit your home, whether that's going into assisted living or passing it along to relatives, the bank only takes up to 90% of the appraised value of it. There's never a check that someone would have to write after you've passed in order to get that home sold. Typically, we say that you must own your home outright, or at least have 50% loan to value in order to get into a reverse mortgage. That's really, once again, the protection for you and for your asset. Because a reverse mortgage loan increases over time, the goal is that the loan balance increases in similarity to the appreciation of your home. So once you're at that 50% mark, that tends to happen more frequently. There are two different options for reverse mortgages. So it can be a fixed. So you turn your current mortgage or your paid off home into a fixed mortgage. You can either receive payments or a lump sum that comes out of your house, and then you no longer have the principal and interest mortgage payment that you used to have. Or you can create a line of credit with a reverse mortgage as well to pull on it as you need to, allow it to appreciate, pull on it more as you want to. Both of these options, at any point, you can make a principal payment and interest payment if you choose to. The other thing that you do want to keep in mind is that when the borrower no longer occupies, you must sell the home or refinance it within 90 days. There are extensions that you can go from there, but it is something that you want to make sure that there's a plan in place, whether it is through a trust or other legal documents, to make sure that they're taken care of. Next up is a HELOC, so a home equity line of credit, aka a second mortgage. So you have a first mortgage on your home, or maybe it's paid off completely, and you're under the age of 62 and you want to access that equity for paying off debt, for purchasing a second home, for having down payment for children or grandchildren to purchase their home. You need to make that equity liquid, and a home equity line of credit does that. The rates are variable. They're based on the prime rate right now, which is 7.75%. And the loan to value also varies as well too. You can borrow usually up to 90% of the value of your home, but there's a lot of caveats as well to credit score, debt to income ratio as well too. This is similar to being qualified to a regular mortgage. So you would have to have income to cover the payment. We would take into account other debts that you currently own. You can use the equity to pay off those debts. Sometimes that helps. A lot of times when we look at the financial picture of someone when they're applying for a mortgage, it's not just about that mortgage. It's about all of the parts that you can have so that you make sure that you are looking at, if we liquidate an additional $15,000 in your equity, but pay off that car loan or pay off that credit card, all of a sudden you have better monthly cash flow, which is really the goal of liquidating that equity. These are also easy to apply for. You can apply to open one as soon as 90 days after you've purchased a home. You also want to apply when you have a little bit higher value and or higher income, because the more access you have to that equity, the more access you have to that income, the more of a line that you can pull. And once you qualify for it, you can draw on that line for 10 years. And then after 10 years, it goes into full repayment. During the first 10 years, it is interest only. So like Brian said, a lot of times when someone is doing a large renovation or even a smaller renovation on their home, it's great for them to make sure that they have all of that option for the first 10 years and not have to repay that principal because maybe they're waiting for the second step of selling that home or refinancing both the loans into one in order to do it. It's a very flexible way to access your equity. And one of the other options that we have as well too, it's called an all-in-one loan. So we just talked about home equity lines of credit. There's an option to actually have a first place home equity line of credit. So you don't have to have a first loan in order to make this work. It basically turns your first mortgage into a home equity line of credit, and it gives you access a little bit longer. So it's a 30-year home equity line of credit. You have access to that equity for all 30 years. It does go down over those 30 years, just so that once again, we're protecting your equity. We're making sure that when you go to sell that home, you haven't maxed out that line. But it basically has an integrated sweep checking account so that as you get large commissions, as your savings builds, as you have that emergency fund sitting in that checking account, it reduces your loan balance nightly, and therefore you pay less interest. You pay simple interest versus that loan amortization schedule, which if you've ever purchased a home, you've seen and looked at and said, oh my goodness, how much interest am I actually paying? This type of loan doesn't have that, which I think is a really great option. Also, this can be used to purchase or refinance a home. So if you're in your home, you want to pull out funds to take care of it, you want to pull out funds to purchase that beach house that you've always wanted for your family, you can actually use your home as your own bank. If your home is worth $800,000, you could pull out $600,000, purchase that beach home, and you're going to have better terms and better interest on a primary residence than you would on an investment home. That could be something that for your financial picture really does make the most sense. And it really gives your clients access to funds quicker with faster payoff results and a couple of other options as well too. So I know that is a lot of information, and that's why on slides, I try to make sure that we have a lot of great questions and a lot of great options that we can talk about, because each person's financial situation is so unique. Timelines vary, horizons vary, and ultimately your goals vary as well too. So I would love it if you guys have any questions to reach out. You can call or email me here, and I'd love to meet in person or over Zoom, just like we're doing right now, so that we can talk about your specific needs. That's it. Thank you guys so much.
Thanks, Jessica. That was great. So helpful in planning for the future. So, and our next speaker is Alisha.
Hey, thanks guys. Wow, I've learned so much today. This is fantastic. So I'm Alisha with Oasis Senior Advisors. I am a senior living advisor. I'm here today to kind of talk a little bit about the role of a senior living advisor. And I'll dive into, since our topic is really focused around homes and what happens with your home. Most of my clients are seniors and a lot of their equity is in their home. So we're going to talk about that a bit today too, and what that looks like when the time for care needs comes into play. One of the things I like to do when I start off is mention that I'll be talking about some thought bombs. I like to call them thought bombs. They're thought-provoking questions. And I also like to address, that we're all guides here. If anybody's ever worked with a guide service before, there's a lot of benefits that come from working with a guide. And it's not just one guide that's needed during this time, planning for late life, right? We almost need special guides in several areas. So it's a team of guides that we're really looking for to help us with coming up with a good plan. So a guide service, they offer benefits such as being able to share their experiences and stories, coming up with questions that you might not have thought to ask, really understanding their area of service and helping you to explore how that pertains to your situation in particular. And when you don't have a guide, things can get overwhelming fast, right? You don't know what to look for. You can get frustrated with all the unknowns. The more difficult the path, the more beneficial it is to have a guide. So when I meet with a client, typically I go to their home during that first initial consult. We meet for about 60 minutes, sometimes longer. And most of the meeting is what I call discovery questions. I'm just asking a lot of questions, as I'm sure the folks here today are doing similar with their clients, to understand their specific needs and situation. I'm walking through things like, who are the family members or support people that are involved with this person's current needs and situation? Where would they like to see themselves? What kinds of things are going to be most important to them? What are some of the concerns that they have in the house with their current living situation? What things are becoming more difficult for them to do? Are there stairs that are a concern that the senior's navigating to do their laundry on a regular basis? Is it that they're having a hard time standing long enough to clean their home or to take care of their yard work? What kinds of supports are currently in place that might be coming into the home? Are they still driving? Are there transportation needs? Are there neighbors who are helping them out? Do they have any sort of safety checks, right? If somebody hasn't heard from them in a while, who's checking on this person? I had a recent client who, she's 89, she's fairly healthy. She's got some macular degeneration, so her vision is starting to affect her at home. However, she's doing everything on her own. And one of the things I like to ask is, what prompted you to reach out and start thinking about some options here, and how do you feel about a move from your home? And she gave an answer that I hear quite often, which is, I just want to pass away in my sleep at home. And that's a great thought, right? Wouldn't we all? Unfortunately, it doesn't work that way. More often than not, it's a slow decline, right? We start to need a little bit of help at a time, and we're pretty resilient. We can hang on through some tough stuff and a lot of health changes. And so more realistically, what I see is people struggling when they're starting to need support with care, like medication management, toileting assistance. Those are really tough to manage at home, even with in-home care. So another popular thing I hear is, I want to stay home as long as possible, and in-home care is the route I want to go. That's great up until a point, right? When does it make sense financially to make a move from that? 24-hour in-home care is difficult. It's $30,000 to $40,000 a month right now. So it is the most expensive option. And for many people, they can't afford that. For many people, their assets can be tied up in the home, right? So then what? In Jessica's case, maybe you're talking about a reverse mortgage, or you're talking about somebody who already has a line of credit. They can pull from that to continue to pay for in-home care for a while. But does that limit your options for other care settings in the future? Absolutely. There are things like, Medicaid and applying for Medicaid that could impact how many options you have available if you can't private pay somewhere for a period of time. Next. So one of the other things I'll talk about with families is, do you understand what are the different levels of care? I talked briefly about in-home care as an option. If in-home care is not a good option anymore, there aren't just traditional nursing homes anymore. So I think a lot of seniors I come across are like, oh, I don't want to be in those places where you have a curtain between you and the neighbor, and it feels very much like the traditional nursing home. And they don't realize how many different options are out there, that assisted living isn't about taking away all of your independence. They want to help promote you to continue to do the things you can do. And they're there just to help with the things that maybe you need a little extra support with, whether that be safety or medications or any hands-on care items. So we talk about, when is assisted living appropriate, and what are the other options outside of assisted living? Adult care homes, residential care. Sometimes if there are concerns with cognitive deficits like dementia, we'll talk about residential care or memory care options. We talk about, what is offered in these different types of settings. And then I'll ask the clients, where do you see yourself fitting? If you did have to make a move, what would have to happen before ready in your mind to consider some of these options? And that's a thought bomb, right? Stumps a lot of people. They don't know what ready looks like. They're not ready, right? And so a big part of my role is just to help provide education around these different options and help them to understand what is offered at each level, and then how much it costs at each level. I answer a lot of questions around, what happens if your loved one is showing signs of dementia and you're just not sure when is a good time to move forward. We'll talk about, do you have power of attorney in place? Have you met with an attorney to talk about estate planning documents? Is there an advance directive in place? Sometimes I'm just plugging them into other resources to help them really understand what's necessary to have in place outside of making any decision to move, right? It's just like, if there's an emergency tomorrow, what happens, and who knows what your wishes are. It's so important. Okay. What's the best that could happen from working with a support team? Obviously, we're talking about trying to avoid crisis planning. I would say, as senior advisors, service about 60% of our clients are in the middle of an emergency. They're in a crisis. A fall happened, a heart attack, a stroke, a change of condition. That was what prompted the discussion around leaving their home or care or next steps. And this is a big process. There's a lot involved here. And so if we're waiting for a crisis to even start the discussion, talk about adding overwhelm on top of a really difficult situation. We're compounding here. So my goal in collaborating on this resource group and trying to get the education out there to people before they reach crisis is just that. Like, let's get the conversation going. I know it's uncomfortable. I know we want to pass away in our home peacefully, but it's never too early to have a plan. And even if plan A is staying home as long as possible, what does that look like? Do you know what your budget is? Have you sat down and really dug into, what am I spending every month and where is my money going? And in order to really come up with a good plan, I think it is necessary to have a whole group of guides who can walk you through each of these different phases so that you can understand what your options are and how long your money is going to last. And your family is aware, your loved ones or your support system is aware of what your wishes are there too. So there are folks like myself and our other speakers within our group who can be your guide, who can help you navigate and further the discussion before a crisis happens. Using the right approach is where I come in. I can help with an approach that feels collaborative, doesn't leave the senior feeling like they're children or family are telling them what to do. I can be your advocate, your emotional support, your cheerleader, your local guide, someone who knows the industry and knows how to empower you to make an informed decision for your loved one's care. If none of this resonates with you today personally, you might encounter a friend or a coworker who's going through this with their loved ones. It's a great time to introduce a resource of a senior living advisor who can step in and eliminate some of that overwhelm that goes along with this journey. Oasis Senior Advisors is licensed by the state to provide this service to families, which is completely free to everyone. No obligations or contracts to work with me. Let's not wait for the crisis to keep the conversation going. I'm your local guide.
Thank you, Alisha. That was really helpful. I know people have a tough time with those conversations, and bringing a third party in to really just speak to the person does help change the dynamic a lot, which is why we all want to be resources, because sometimes there's just a different dynamic between a parent and a child. And when you're trying to switch that role where you're the, the parent and they're the child, makes it uncomfortable. So having a third party who's an expert in these different categories really takes that confrontation out of it. And it's really just like, let's bring in somebody. So, our most important point to get across today is just to make sure that you have a support team before the crisis hits. So have a financial planner, a tax advisor, a health insurance advisor, legal counsel for estate or elder care, a long-term care or senior living advisor, a mortgage broker who understands your goals for retirement, and a senior real estate specialist who's invested in helping you find your forever home. And ideally, your team will communicate well together to make sure that you're holistically covered. So thank you again for the opportunity to share today. We are super excited to have you as a guest, and we're going to be sending a resource packet to the email address that you used to register for this webinar. So you'll have all of our contact information. And if you want to set up any free follow-up appointments with us, feel free to reach out. We're going to stop the recording now and open up the microphones for a Q&A portion of the webinar.